Most people think insurance companies make money by selling policies. They're not wrong. But that's just half of the story. Because insurers are constantly making another decision behind the scenes, which is where should capital go? That's the question they ask themselves. Into underwriting or into investments? And that decision can completely change profitability, risk, and long term strategy. Yeah, that's the subject of today. So, hello everyone, this is Diego. Welcome back to the channel. And here we do explore quite a bit of FP&A, insurance finance, and the strategic mechanics behind how insurance companies really operate, right? In the last video, we talked about how growth can actually destroy ROE. And today, we are taking the next step and talking on how insurers decide where to allocate their capital. I hope you enjoy. Sit down, grab your coffee or cup of tea, and let's go about this. To kick things off, we're going to discuss the two engines of insurance. At a high level, insurance companies operate with two major engines, right? So, the first one being underwriting. Everyone knows about this. That's the core business. Collecting premiums, managing claims, and pricing risk. The second is investments, because insurers hold massive amounts of capital and float, and that money gets invested. So insurers are constantly balancing two sources of return, being underwriting profit and investment income. And the interesting part, well, both compete for capital, which is limited, right? Like there's only so much you can have. So another point here, why capital allocation matters? Well, as I said, capital is limited, so there's only so much you can have. And in insurance, capital is extremely important because it supports risk. The more exposure you take on, the more capital you generally need to hold. So insurers need to ask, where can we generate the best return relative to capital being consumed? Because not all growth creates value, as we discussed in the earlier video. Some underwriting lines generate attractive returns with relatively low capital strain, right? Others consume huge amounts of capital while adding volatility. And investments have the same dynamic. Some are stable but lower return, as we all know. Others offer higher return but increase risk and, really increase risk significantly. Well, now let's put them face to face here. So underwriting versus investments. Let's simplify this. Underwriting can generate strong returns when pricing is disciplined and claims are controlled. But underwriting is very volatile. So, catastrophic losses can hit, claims inflation can rise, pricing cycles can deteriorate. Investments, on the other hand, tend to be more stable, especially in fixed income portfolios. But returns can be lower as well, right? Especially during low interest rate environments. So insurers are constantly balancing two things: higher potential underwriting returns versus more stable investment income. And this balance changes depending on market conditions, what else? Interest rates, risk appetite, regulatory pressure, as well as capital position, right? let's talk about the strategic thinking behind this now. Strong insurers don't simply chase premium growth, as we already noticed here in the last video. They think strategically about capital efficiency. So they ask themselves, which business lines generate the best risk-adjusted returns? Which areas create too much volatility? Where is capital being underutilized? And this is why you will sometimes see insurers pull back from, certain products, reduce exposure, shift portfolios allocations, or rebalance their underwriting strategy. Not because they can't grow. It's basically, because capital allocation is ultimately a strategic decision. And what really happens in the real world? So let's try to put an example here to make things even simpler. So imagine two business lines. One grows quickly but consumes massive capital and generates volatile earnings. The other grows slower but produces stable, capital efficient returns, right? So we have those two. From the outside, the first one look more exciting, but strategically, well, the second one may create far more long-term value. That's how insurers think, basically. And to close off things, well, what can I say? Insurance is not just about premiums. I am still repeating myself here about this. It's about how capital is allocated across risk and return. And the companies that understand this well are usually the ones that perform consistently over time. In the next video, we'll explore one of the most misunderstood concepts in insurance. The difference between economic capital and regulatory capital. That's very interesting, actually. Follow the series if you want to understand how insurance really works at a strategic level. Thank you for watching. I'll see you in the next one. Cheers. Bye.